Hello, everybody. We're going to start our 2023 forecast meeting, and can't hear me? I think, hi. Okay. It's a pleasure seeing everybody tonight, and it warms my heart to see so many clients that have been with the firm for so long. I thought when I was driving here, I have people raise their hand if they remember me when I used to have hair. and you know, many of you have been clients for 5, 10, 15, 20, and I think we even came up with 30, right? I think. It's getting hard to remember how many years it's been, but when I look out across this room, I see that there's a lot of people that have helped us grow, and most of you have all given the firm a referral, and for that we appreciate it, because we don't spend a lot of money on advertising, and I know a lot of you are real advocates and sing our praises, so we appreciate that. I also noticed that there's a lot of super smart people in the room, and the super smart people are the people that are engaged with us with our weekly market commentary, where you've answered the riddle, and I noticed the same people are on that. Excuse me, are on that list over and over again. So I'm thinking, either you guys are really, really smart, or that riddle's really, really easy. So I also want to take a moment to introduce the other super smart people in the room, and those are the people that are working, you know, on your behalf at the office. And the first person I wanted to introduce is Vicki Cantor. She was been up on the screen, and she's right over there. And we're really blessed to have Vicki. She comes with a lot of experience and maturity. She has been with another LPL office, so she knew our systems, and she knew, you know, exactly how our software worked. So she was able to step right in. And one of the things that Tom and I asked her to do was to evaluate our processes. And you know I'm a real stickler for processes. I have checklists for everything. The checklists keep getting longer and longer, and it's like, oh, that should be on the checklist. And I felt like we had really good streamlined processes, but I was wrong, because Vicki has really streamlined our streamlined process. So Vicki, it's been great working with you, and thank you to Ann for putting on this event. I know you spent a lot of time putting it together. So there's Ann over there, you know Ann. And Ann mostly works with the community. She's the face of the company in front of the community. And Will's the young whippersnapper that comes in early and stays late. And he's currently studying for his CFP. And Will does all of the trading and research, and then he takes all care of all like the loose ends, and he picks up just about anything that needs to be done in the office. Tommy over there, Tom's the other advisor, you know Tom, and you'll hear from him later. And am I missing somebody? Vince is around here somewhere. There's Vince. Vince does the taxes. Most of you know Vince and are working with him. If you remember back in the summer, I was telling you a story about a new dentist that I went to, and it was a story about how people your own, as you get older and you see people that you've known for a long time, and you look at them and you wonder why they look so old, and when you don't think you look that old. Do you remember that story I told? Well, I kind of realized it's the same thing with your memory, that also, you know, seems to go as you get older. And it reminded me of this story of these two couples that were walking through the park, and they were on the pathway, and the women were walking ahead of the men. And the one guy goes to the other guy, he said, "Last night I went out to dinner and we had the best steak. It was so good, it was juicy, it was cooked perfectly, really tender." And the other guy goes, "I love steak. What's the name of the restaurant?" And he goes, "Oh, what's the name of those flowers? They come in different colors, they smell good, and they have thorns. And the guy goes, Rose? Yeah, yeah, yeah. Hey, Rose, where did we have dinner last night? From a market's perspective, who is glad that 2022 is done? Yes, we all are. Boy, it was a tough year, especially for the bond market, and Tom's going to talk a little bit more about that later. So we've had a lot of challenges, and through those challenges, we're going to find new opportunities with every high and every low that we are experienced through the last couple of years. It's no surprise with all of these challenges that we haven't been looking for balance, whether it's about the markets, the global economy, or what's happening in our local communities. The news we're hearing on a daily basis has the potential to disrupt our lives. But with resilience, perspective, and the supportive connections, we can navigate it through it all and start to gain our sense of equilibrium even after a year like 2022. After 2 years of disruption due to the response of the COVID-19 pandemic, we're searching for some kind of normalcy in our lives, while at the same time, we're experiencing the after effects of the pandemic. Some of those after effects include imbalances created by fiscal, monetary, and public health policy put in place to address the pandemic. And as those process of addressing those imbalances, that has become disorienting at sometimes. If 2022 was about recognizing imbalances in the economy and starting to address them, we believe that 2023 will be about setting ourselves up for what's to come next as the economy finds its way back to steadier grounds, even if this adjustment period that we're in continues. In 2022, the Federal Reserve aggressively fought inflation by raising interest rates. In 2023, our expectation is that the Feds will find that point that it can stop raising rates as inflation starts to get under control. The Fed's efforts to control inflation through 2022 pulled interest rates off extremely low levels that were historically unprecedented. And as you know, rising interest rates have been really painful for us as partially having our money in bonds. But for the first time in decades, savers can actually earn interest in 2023. And we'll be more, and this is a significant shift that we're going to be focused on. So as an example, one of the things that we've done I actually don't recall the last time we had done this, is that we're actually buying treasury bills in your accounts. And as you know, we started to raise cash about a year ago, and instead of just sitting in an insured money market account, we started looking at the 90-day T-bill and discovered that we were getting, what are we buying it? Around 4, a little less than 4, a little over 4. This is a big shift, okay? Because you haven't been able to do that for a long time, and the opportunity there is that eventually what's going to happen is that the Feds are going to get inflation under control. The economy most likely is going to go into a recession. And we spent a lot of time talking about a recession the last time we met in the summer. But what's going to happen is that eventually the Feds are going to have to raise interest rates to stimulate the economy again. And so when interest rates go down, bonds do what? Go up, right. So a shift could possibly be that we could go out and buy a 30-year bond, a 30-year treasury bond. Now I see some of your eyes roll and think, well, Tim, I don't have 30 years. What are you going to buy a 30-year bond for? Well, we're not going to hang on to it for 30 years, not necessarily. I doubt it, but the advantages of buying a 30-year bond is that the longer the term of a bond, the more money you make when interest rates go down. So as we see it, we look at the bond market as the possibility of getting a stock market like rate of return in the bond market this year because of what we think will happen as the Feds start to lower interest rates to stimulate the economy. But not only do we not have balance in our life, we're struggling for that. The bond market's struggling for balance. The equity markets also lacked balance. There's been a lot of challenging macro environment, overwhelmed business fundamentals. Stubbornly high inflation, sharply higher interest rates were the dominant market drivers that pressured valuations in stocks, stoked fears of recessions, and falling corporate profits. In 2023, we look to the equity markets to find balance between the key macro factors like inflation, interest rates, Fed policy, and business fundamentals. If stocks are going to go higher this year, a prompt end to the Fed rate hiking campaign will likely be the key component. The timing of the last rate hike is uncertain. It won't be clear for a while, but our view is that the Fed should pause hiking rates sometime this spring. Because what's happening is we're starting to see inflation is starting to improve and the job market is starting to loosen. Should that occur, stocks would likely move higher consistent with history. Stocks have tended to produce solid gains after hiking cycles, including a 10% average return gain 1 year later. So what I'm saying is once the cycle of hiking rates stop, you look at the stock market, it's averaged 10% a year later. You know, you've heard the old saying, what goes up must come down. Well, that's also true for the stock market, but the opposite way. Through many economic downturns, recessions, geopolitical crises over the decade, the stock market has always recovered. The patient, courageous investor who are able to take advantage of those declines have usually been rewarded nicely. Following down years, the S&P 500 has risen on average 15% with positive returns 15 out of the last 18 years. We experienced a turbulent year in 2022. While I can't say exactly when this turbulence will end, it looks like it's starting again, right? This week has been pretty turbulent. But the economy and markets have already made meaningful progress towards rebalancing. Inflation is receding. We think the Fed rate hikes will be ending in the first half of this year. Labor markets are loosening. And voters have chosen for a more balanced government where one party doesn't control both the presidency, the House, and the Senate. And the stock market prefers it that way. They prefer the power to be split. And even if the environment remains uncertain, the ongoing process of finding balance may be starting to create opportunities for us. Higher interest rates bring a much improved outlook for bonds. At the same time, segments of the stock market that were expensive are now becoming fairly priced, while other segments are actually looking pretty cheap. Knowing when to shift from opportunities is also a balancing act. We need to account for the ongoing risk of inflation, the possibility of a recession, and global conflicts, while also understanding the markets are always looking forward, thus anticipating the changes that they may respond to. When we talked about that last summer, how the market's always 9 months looking ahead. So again, if we say, oh, we're in a recession, or we've been in a recession, it's already happened. The market's looking past that, because by definition, a recession is 2 negative quarters of growth. So we have to look forward of what the market's looking at, and we believe that the best path forward is to have an investment process that stays focused on opportunities that will be presented to us this year. We're going to use our indicators. They're going to be our guide. They're going to be our guide on how we readjust in the economy and markets and how they may impact you in the coming year. This disruption may not be fully resolved, and there may be challenges to come, but progress towards finding balance is well underway. I want to, again, thank you for being here tonight, and I'm going to ask Tom to come up, and he's going to talk a little bit about our strategies and what to expect going forward. Thank you.
right. Well, I guess I'm not too far behind you, Tim, with that that hair thing going. So hopefully some of you guys will remember me when I still have hair. But thanks, Tim. Hope everyone's having a good evening. I'd like to touch on a few points this evening, discuss areas of the market that we favor, and share some of the trades that we have done in the strategies since the last time we met, which was the halftime report back in July of 2022. Regarding equities, we still, again, favor large cap U.S. equities, primarily value companies, which simply means that they're large companies that pay dividends. We've continued to trim the growth stocks, both in the large cap as well as small cap, and allocated, as Tim had alluded to, treasuries and just some cash. Regarding our sector positions, we still retain technology, healthcare, and industrials, and most recently we traded out of the financials into utilities. Tim did speak about rising interest rates, and there's no doubt that they rose last year, I think more rapidly than anyone had really anticipated. The Fed raised interest rates 7 times, and we know when interest rates rise, bond prices go down. And last year, the bond market was down just as much as the stock market, so we weren't very happy with that either. So, but we're in an economic cycle. I guess we're always in an economic cycle. The Fed is raising interest rates right now, and to tame inflation. And when that happens, they're going to reach their goal. It's going to happen. They'll eventually decrease rates, and that will stimulate the economy. And the good news is that when that happens, when there's a pause or a slight decrease of even like 0.5% in interest rates, it can have like an upwards effect of like 9% on our bonds. So needless to say, we've never found a time that we've loved bonds more than now. They are still attractive, so we're going to continue to hold them and just make adjustments going forward. We did take advantage of this price reduction last year. So we did exchange some of the bonds, which will therefore obviously have some positive attributes in terms of enabling you to save on your taxes going forward. There's always going to be areas of the market that outperform depending on the current market cycle. So we're just going to continue to be as flexible as possible and change as the environment indicates. So. Now I'd like to turn over the mic to Alec Morrison. He's going to go ahead and introduce our speaker, Brian Levitt. They're both from Invesco, and we are an independent firm. I seem to say that every single year, so you guys probably could say this better than I can standing up here. But we're an independent firm. We literally don't have anyone that dictates who we need to do business with. So we partner with the best money managers that we can find. And they're, a part of our little circle of trust, as we say. So that's about it. One last thing, this is a compliance-related issue that Invesco is not affiliated with Valley Oak Wealth Management or LPL Financial. Thank you.
Hey, good evening, everybody. My name is Alec Morrison. Like Tom was mentioning, I'm the regional consultant for Invesco out here in the Bay Area and then the Marin County. First time being at the Marin Country Club. I just came from Chicago, so this is a beautiful event, and I hope you guys enjoy everything tonight. I don't have too much to say. Tim and Tom both summed it up very, very, very well. 2022 was a year for the books, not in a good way. Bonds were down 15% at one time. Stock market was down 20% at one time. And that really hasn't happened since the 60s. So it's been a very, very stressful year, and it can be unnerving for clients and obviously for portfolios. So it's my honor tonight to introduce Brian Levitt. Brian is the global market strategist for Invesco. He really produces all of the thought leadership that surrounds a lot of the portfolio management decisions and strategy that we do within the firm. So with that, Brian, knock it away.
Thank you. Thanks, everyone. Good evening. I'll give this a try without PowerPoint. If anyone misses PowerPoint, just let me know, and I'll pull up some slides for it. I thought maybe we would enjoy our time a little bit more together if we just have a conversation. So First thing I want to do is empathize with all of us. And this has been a crazy couple of years, right? It's not usual where you go through a pandemic and shut down large segments of the global economy, then have a massive response from government, from administrations on both sides of the aisle and the Federal Reserve that put a lot of money into people's pockets before the global economy was ready for it. And so you ended up with inflation for the first time in 40 years, which brought forward Fed tightening, meaning the Fed's raising interest rates, which slows down the economy, creates concerns about a recession. All in a 2-year period. That's a very, very unique environment. And what I'm going to talk to you about is this road, this path to a recovery, which we're all going to be on over the next couple of years. And so my talk is going to be an optimistic one, a hopeful one, and I'll explain to you how I get to that conclusion. So before I do that, let's just think about what happened last year. Okay, how do we explain it? It was the everything bear market. How do you get an everything bear market? Okay. The interesting thing is, in good times, people always ask me, when's the volatility coming? When's the drawdown coming? When's the market correction coming? It's like we can't leave well enough alone, right? And so that was probably the one or two biggest question I got in 2021 was, when's the volatility coming, or when's the correction coming? The second one probably was, should I buy Bitcoin? Okay, so my response to that invariably throughout my entire career is that volatility, market drawdowns, market corrections, they don't come out of nowhere. They're almost always the result of policy uncertainty. And the challenge that we had last year was because of all the money that was put into the system before the global economy was back to its productive capabilities, created inflation. And when you have inflation that keeps rising, the policy uncertainty extends. And even now, in January 2023, we can all debate when the end of the tightening cycle is coming and at what interest rate, but the reality is we're a lot closer to clarity. Now, you may be sitting here saying, well, what about the debt ceiling? Isn't that policy uncertainty? Sure. We'll have to deal with that, and I'll talk about that in a moment. But that's not persistent policy uncertainty. We'll get through that. What happened with the Fed, what happened with inflation was this ongoing uncertainty. Now, what happens when you came into 2022, interest rates were virtually nothing, and so you're willing to pay a lot for stock earnings, right? If I can't earn anything here, I guess I got to pay up for earnings. And when rates went to 4, I don't have to pay so much anymore. Now I can pay this. And so valuations adjusted. It's really the story of 2022. Policy uncertainty creating volatility, markets going down because valuations on equities needed to adjust because now you had another alternative to owning equities. Okay, you probably all know that. So let's talk about where we go from here. Now, as a strategist, I always need to ask myself the same, call it 4 questions. It doesn't matter the day, it doesn't matter what's going on in the world. I always ask myself the same 4 questions. Number 1, where are we in the cycle, in the market cycle, in the business cycle? And I think a better way people are asking that right now is, are we going to have a recession? Right? Because you could either be early cycle, mid-cycle, or later in the cycle. Are we going to have a recession? And if so, why do we care as investors? And I think Tim and Tom started alluding to this. Number 2, what's the most likely direction of travel of the economy over the next quarters? Economies move through different phases within cycles, so what's the next most likely path of travel? Number 3, what are the policy implications? So what's inflation doing? What's the Fed going to do as a result of it? And number 4, and I've always believed that if I can get the answer to those 3 questions right, then I should have a good guide on what my asset class implications would be. Anyone missing PowerPoint yet? No. All right, we're good? Okay, so where are we in the cycle? How do recessions happen? It's usually a 4-step process. Number one, you usually get leverage that builds up over the cycle, meaning consumers borrow too much, businesses borrow too much, the banks become poorly capitalized. I'm going to argue we don't have that today. This is a unique pandemic cycle where consumers actually came out of it in reasonably good shape. Businesses are not over-levered, and to the extent that businesses have debt, it's at very low interest rates. They refinance just like all of us did. And the banks are very well capitalized after a 10-year period of being overregulated. So it's not a story of leverage. So we don't have step one, but we have steps 2, 3, and 4. Step 2 is you get elevated inflation, and the Fed starts to raise rates. And there's an old saying that goes, of all the cycles, none of them died in bed of old age. They were all ultimately murdered by the Federal Reserve with interest rate hikes. Okay. When the Fed raises rates to the extent that they have, from 0 to 4.5 in 9 months, which, by the way, is the greatest magnitude in the shortest period of time in our lives, growth starts to slow. And so that's step 3. The economy starts to slow. And then step 4 is the banks start to worry about the economy slowing, and they tighten credit conditions. They lend less because they're worried about the health of the economy. So I would say, no, we don't have leverage problems, which is a good thing, which is why you hear most people talking mild recession. But we have inflation, the economy's slowing, and the banks tightening lending standards. So I would sit here and say, yeah, there's a reasonable probability of a recession. Now you have to ask yourselves, why do I care? Right? As we heard earlier, markets are leading, not lagging. Markets are looking forward. Now, if you think about each of the past 10 recessions in the United States, and you look at the peak to trough decline associated with that recession, how bad did it get? The average down is 31%. Now, we've already done 25.4. Okay, so you could say we're 80% of the way to the average, but the reality is averages lie, right? There's some that are far more extreme, and there's some that are far more mild, and you get this average of 31, 32%. So which ones were more extreme? 2008, down 50 to 60%. 2001, down 50 to 60%. 1973, down 50 to 60%. And the challenge of those was it took you years until you got back to where you were, back to the prior peak. So is it in 08? We already talked about this. The American households are well positioned. The banks aren't undercapitalized. Doesn't feel like 08. Is it 01? Well, you might say there's some parallels. Fed's raising rates. Tech stocks are selling off. But 01 was really exacerbated by accounting scandals in the United States, by a domestic terror attack. So it doesn't feel like 01. Is it 1973? Well, you say, yeah, there's some parallels. Inflation is very elevated. There's conflict overseas that caused oil prices to go up. Maybe it's 1973. But in 1973, long-term inflation expectations in this country were 10%. Today, they're 2%. Right? So in 1973, the Fed lost credibility. 10% inflation expectations? Could you imagine? I wasn't born, by the way. I read this in a textbook. So, but could you imagine? Today, 2%. So it's none of those, right? It doesn't feel like one of those. So I would say then it's probably one of these more mild recessions where you go down something like 20 to 25% and you recover in a couple of years. And you probably remember some of those recessions. 1981 is a good example. 1991 is a good example. Market goes down, again, 20 to 25%. Within 2 years, you're back to the prior peak. Again, we've already done 25.4. So we've priced in a recession. We've priced in a mild recession. Now, that doesn't mean you necessarily go straight line from here. You know, the market's been retracing higher. Maybe you have concerns over a debt ceiling. Maybe the economy slows a little bit more and you retest down a little bit. But ultimately, I believe the bottom's in for this cycle. I believe that we've seen the bottom. Again, not a straight line, but we've likely seen the bottom. The best historical example, the best parallel that I could probably give to you is 1980 to 1981. Okay, I was actually alive then, but I was only like 4 or 5 years old. In 1980, inflation peaked in March of that year at a very elevated level. Paul Volcker and the US Federal Reserve raised rates through the end of the year. So from March 80, it peaked. They raised rates through the end of the year. They raised rates so much that you had a recession in 81. Okay? Now, ask yourself, if you invested when inflation peaked in 1980, how did you feel over the next 2, 3, 4 years? Quite good. In fact, any time in US history when inflation has peaked at high levels and come down, you've done very well over the next 2, 3, 4 years. So how does that compare to today? Inflation peaked in June at 9-point-something%. Jay Powell and this Fed raised rates through the end of the year, just like Volcker, maybe into the beginning of this year, or certainly into the beginning of this year. You're probably going to have a recession that may create some volatility in markets, but if 81's a good guide, or 1980, 81's a good guide, you do quite well investing when inflation has peaked, right? Or said earlier, you do well investing when the Federal Reserve is done tightening. So even though you're going to hear a lot about a recession and the media is going to drum up all of these concerns about recession, remember the market goes first. And the market priced that. From here, the market is going to trade on whether things are getting better or worse relative to expectations. And everybody's expectation right now is high inflation, policy tightening, recession. It's likely going to be better than that, right? Inflation coming down, Fed backing off, mild recession. So that's the cycle. The next is the direction of the economy. Economies move through 4 phases: recovery, expansion, slowdown, contraction. Now, what's weird about the last 2 years is we did all 4. We recovered in the second half of 2020. We expanded in 2021 into the beginning of 22. We slowed in the spring because of Russia going into Ukraine, high gas prices, high food prices. We began showing signs of a contraction this summer, markets showing signs of it, markets starting to pick up fears of a recession, and now the market's taking on a bit more of a recovery tone. Recovery tone meaning stocks have been doing well, cyclical stocks have been doing well, emerging markets have been doing well, so more of a recovery tone. Now, is that game on? I mean, is it game on? Is it risk on? No, we have some challenges in the near term, but the way recoveries play out, again, is inflation coming down and the Fed backing off their tightening stance. So why does inflation come down? Why does the rate of inflation come down? First, the growth in the money supply is coming down rapidly. So all the money that the government put into the system, Federal Reserve, low rates, you got $4 trillion from the Trump administration, you got $2 trillion from the Biden administration, that's all gone, right? So the growth in the money supply is rolling over meaningfully. Second, the goods inflation story is over. Remember the supply chain challenges and the goods inflation? Why did that happen? Think about what sales did. Sales are going along. We have a pandemic, they collapse in a really scary way. Why did they collapse? three reasons. We didn't know if we'd keep our jobs, we weren't going to the mall, and we were afraid to shop online because we thought we had to wipe down the boxes. Okay? Then we found out we either were going to keep our job or the government was going to give us a lot of money. We still weren't going to the mall, but we could shop online. And we went on spending sprees. Guess what? We went on spending sprees. Okay, let me take a step back. Sales go like that. What do businesses do? They slash inventory. And they cut workers. Too late. So we start spending, they don't have enough inventory. It's the first time you get inflation in 40 years because there's too much money and there's nothing on the shelf. And then every business works at the exact same time to rebuild inventory, but we're going through a global pandemic. Vietnam isn't vaccinated yet. Thailand isn't vaccinated yet, etc. So we progress through these challenges. All the while, stocks start to fall, crypto starts to fall, bonds fall. We're all feeling less wealthy, and our sales start to slow. What have businesses been doing? Kicking up inventories, and they're late again. And you ask retailers, do you have too much inventory? And they say yes. So that's disinflationary, right? Prices start to come down. In the housing sector, mortgage rates go to 7%. What happens to home prices? Right? As much as everybody thinks that they're budgeting for their money down and you know what home they can afford, it's the monthly payment. Right? What did Carville say? It's the economy, stupid. It's the monthly payment, stupid. Right? So rates go to 7, housing prices start to fall. Even wages. You hear about how restaurants can't find people, hotels can't find people, airlines can't find people. Well, ask yourself what wages are going to do in the tech sector, all these layoffs. What are wages going to do in the financial sector? Right? Going to make less than we did in prior years. Right? So all of this leads to an environment where inflation comes down, and I think inflation comes down pretty rapidly. The media does a 12-month% change on inflation. That's what they quote. Right now it's 6.5%, down from 9. If you do a 6-month% change on inflation, it's 0. We've had virtually no inflation over the last 6 months, and the bond market thinks inflation comes down rapidly. So that's how a recovery comes about. We say, what's the direction of the economy? What's the Fed going to do? Inflation comes down, Fed backs off. That's how a recovery starts to commence. So my earlier line, if the Fed ends all cycles, a shift in policy also initiates ultimately the beginning of a recovery into ultimately a new cycle. So how do we think about investing within this? The reason we think about these 4 different phases, recovery, expansion, slowdown, contraction, is because they each have different implications for a portfolio. If you're in a contraction, where contraction largely I'm defining as growth is below trend and coming down, you want to be more defensive if you're tactically minded. And I'm happy to hear that your advisors moved more to cash. What a great idea, right? You want to be more defensive in a contraction environment. Things like government bonds do well, things like high quality bonds. To the extent that you want to own equities, you want to be more defensive, right? That's a contraction phase, and that was largely the trade that we saw last year. As you start to move in towards a recovery, what tends to happen is, first of all, most investors miss it, right? Have you ever seen that, where investors pull money out in the bad year, then miss the best days in the market, and then their returns go down substantially over time? So unfortunately, a lot of investors miss it. What tends to happen in a recovery is that borrowing costs for lower rated entities come down. So things like high yield bonds do well, emerging market bonds do well, municipal bonds do well. Equities tend to perform well. As we're talking about in a recovery, you want to be more value oriented, you want to be more cyclical, you want to look to emerging markets, parts of the world that need the Fed to back off, that need more economic activity. So Yeah, we may have a few challenges in here. Oh, and I should add this idea of rates coming down, certainly. And so we may have a few challenges in here, but the question is, how cute do we want to be about it, right? Are we trying to time based on a potential debt ceiling debate or based on concerns that the market may get spooked by a recession, or are we thinking about what the next few years look like? And again, I come back to my point that every time inflation peaks and comes down, or just about every time, the market historically has done very well. So if you want, I'll make a couple of comments on the debt ceiling. Would that be helpful? Okay. First thing I'll say about U.S. debt is I think people are too concerned about U.S. debt. I think people view U.S. debt very binary, as if there's going to be a moment where it's going to blow, it's going to pop, and the U.S. is going to have these major challenges. I've been hearing that forever. That's very unlikely. Yes, we have $31 trillion in debt, but you probably want to ask yourself what the assets of the U.S. government are worth. I would guesstimate that the assets of the U.S. federal government are probably worth about $200 trillion if you consider all the land, the federal buildings, the military, the gold, the oil, right? So I'm not worried about U.S. debt from a sustainability perspective. Now, it may crowd out some investment, but from a sustainability, but certainly our politicians have concerns about the rate of growth that has been occurred in the debt, particularly the $6 trillion that was spent over the last two administrations. So you have a new Congress that is committed to slowing down some of the spending that we've seen, and in their minds, the best way to potentially do this is to play a game of chicken with the debt ceiling. Now, why do we have a debt ceiling? I don't really know. You can look at the act in 1917 that created the debt ceiling. It was $8 billion at the time. I think it was the Second Liberty Bond Act or something. I wasn't alive then either. So the debt ceiling was $8 billion now. Today it's $31 trillion, so clearly we've raised it some 70, 80, 90 times, ironically more times under Republicans than Democrats. But nonetheless, we're going to go to bat over this. And how does it ultimately play out? I mean, I always go back to the words of Winston Churchill, although it's not clear he actually said this, which is Americans always do the right thing, but only after exhausting all other options. So I suspect we're going to exhaust a bunch of options along the way. Some people are even saying, should we mint $1 trillion coin and put it on reserve at the Fed and use that to pay the interest? Some people are saying, should we invoke the 14th Amendment and say it's unconstitutional to not pay the debt, right? We're going to go through these conversations. Ultimately, what's most likely to happen is the Democrats are going to have to make some concessions to bring 5 Republicans over. That's all it is. There's 213 Democrats. They need 5. Right? And they need 5. So the 15, 18, 20 Republicans that were the holdouts for Speaker McConnell becoming elected, one of those things was on a condition to go to bat over raising the debt ceiling. And so that raises concern. But ultimately, again, you need to make some concessions to bring 5 over, and I suspect that will happen. Now, the challenge for investors is it probably happens at an 11th hour. And the last time we really did this game was in 2011. And if you look in 2011, remember, policy uncertainty, you got a market correction, unfortunately. Ironically, U.S. bonds did very well. The U.S. dollar did very well, ironically. But you got a classic sell-off. Equities underperformed, high-yield bonds sold off. So we may be looking at that type of dynamic by the middle of the year. To me, that doesn't change any of the answers of my 4 questions. It doesn't change where we are in the cycle, it doesn't change directionally where we're going, and it doesn't change what the Fed is likely to do. So I'm not going to change my investment approach around that. I'm going to operate under the assumption that the U.S. is not going to renege on its liabilities. We will ultimately raise the debt ceiling, perhaps after exhausting all other options. So I guess enjoy the theater, get the popcorn, but we'll we'll ultimately get there. So I've got a red eye, but I've left a few minutes to answer any questions that people may have. Yeah. Yeah. So you said the variability of currency rates? Is that the question was on currency rates? Yeah. One of the things that I watch most closely is the U.S. dollar's value against a trade-weighted basket of currencies. Because when the U.S. dollar is getting too strong, that's when economies start to run in, the U.S. economy starts to run into challenge, because the U.S. dollar is still viewed as a safe haven currency. And what ends up happening is money flows to where it's treated best. And so in the last year or so, with the Federal Reserve raising rates to a level higher than when Europe is at, higher than where Japan is at, and trying to restore faith in the currency, the dollar's gone up a lot. And when the dollar goes up a lot, growth slows around the world because the money's getting sucked out of the world and goes to the dollar. So when the dollar strengthens too much, that's a bad sign. Now, what's been happening more recently, as the Fed is getting closer to the end, and Europe's still raising rates, and Japan is getting rid of Treasury yield curve control, then that differential between U.S. rates, or the expectation of the differential between U.S. rates and the rest of the world, starts to narrow. You heard some comments earlier that the Fed could even be cutting rates by the end of the year. So that starts to signal a less strong or even weaker dollar environment. A less strong or even weaker dollar environment historically has been a good risk-on signal, because it means money is starting to flow to other parts of the world, i.e. away from the safe haven currency, the reserve currency of the world, to other currencies. And it's part of the reason why I'm quite optimistic on emerging markets over the next couple of years. Because as the dollar breaks, money starts to flow where yields look attractive, where growth prospects look attractive, and that tends to be more in the emerging economies. Anyone else? Yeah. Oh. Yeah, so does the U.S. lose its status as the reserve currency? Is that what you're asking? Yeah, you have to ask yourself. We'd have to ask ourselves if there's an alternative. Right now the U.S. is the largest economy in the world, controls a lot of the trade lanes in the world, biggest military in the world, and probably most important, deep markets, and investors believe they understand the rules in the market. And so we also have a system of 50 united states, even though they don't always seem all that united, but 50 united states in which we have FDIC insurance, in which we have tax transfers from wealthier states to less wealthy states, right? So we have a system that operates, and people understand how that operates. There's really no other candidates off the top of my mind where that is similar. People had talked about Europe. The problem with Europe is that you have a union, but you do not have United States that maintain the same fiscal policies, that do the tax transfers, right? So Europe becomes less of a viable option. China in 2021, so the renminbi or the Chinese yuan that a lot of people had put forth as the next potential reserve currency, China really signaled to the world in 2021 why that's unlikely, because the rules changed in the middle of the game. The education sector can't be for profit. The big internet companies have to reserve a portion of their profits to go to the state, right? So when you don't understand the rules, you're far less likely to be the reserve currency. And so beyond Europe and beyond China, you'd have to ask yourself, is there another economic bloc or area of the world that is going to be as big as the US, with markets as deep, with a military as strong that controls the trade lanes of the world, with the regulatory rule of law history that we have. And there's really not a lot of alternatives. So, you know, to the extent that I invest in other currencies, it's to take advantage of yields. It's to take advantage of currencies being undervalued. But it's not a structural play in the sense that I believe that the US dollar is losing its currency reserve status anytime soon. Yeah.
Do you have any concerns going forward of continuing large expenditures on Ukraine?
Do I have concerns about large expenditures on Ukraine? I do not, from the sense of the money. I mean, clearly in an ideal world, you put that money to productive use in the U.S. But the money compared to the size of the overall debt level or the deficits in a given year is not nearly as large as some may think. Mostly where we spend our money, and I think Ezra Klein had a good line on this. He said, basically the U.S. government is an insurance company with some tanks, because the way we spend our money is on Medicare, Social Security, and the military, and some level of interest expense. So, yeah, I mean, I don't want to opine too deeply on Russia-Ukraine, but they're currently the front lines of a war that Europe and the rest of the world would very much not want to take on. There's a question here, yeah.
Just for fun, would you give us your opinion about the future of Bitcoins and NFTs?
Yeah. So, look, I'm of the mind that when rates are zero, we speculate. When rates are higher, it's more costly to speculate, i.e. there's an opportunity cost. So when I'm earning nothing here, I'll speculate. When I'm earning 4 here, it's harder, right? There's a real cost to that. Now, I still don't get Bitcoin or crypto from its fundamental use case. I've been being told for 14 years that it's better. But any invention that's better, we embrace immediately. We didn't see email and say, you know what, I'm going to send a fax. Right? And so why aren't we using it all these years later? I Venmo people all the time. One of the things now, you go out with a bunch of couples, you throw the card down, I'll Venmo you. Why are we all signing? And right? So I feel like a lot of that we can already do. Now, the one thing I will say about Bitcoin is, to the extent that people like it, and there's a lot of people that do, we had never seen it in a tight interest rate environment. We had never seen an environment where rates rise. And so we got it at a zero rate world, and as rates stayed at zero, it went to the moon. As soon as we raised rates to 4, it collapsed. But then Bitcoin held steady at 16,000. Didn't want to go below it, no matter how tight it seemed the Fed wanted to be. And so if the Fed eases and brings rates down, does Bitcoin go up again? Yeah, perhaps. It seems to be how it's trading. But does it go to 60,000 again? I would seriously doubt it. To me, it still feels. And the biggest irony of it, when it came out, it was an alternative currency so that those evil bankers can't steal it from you. What happened? They stole it from you. Yeah.
What's your prediction of how many rate hikes are going to be coming up? What percentage?
Yeah, so I think we. Yeah, so I look at the Fed funds implied futures. So the market tends to do a decent job of this, although certainly not with 100% accuracy. The Fed funds implied futures believes that the Fed ends at 5%, and that's around March, April-ish. Now, is it 25-25 or 50-0? We'll see. I would think 25-25, and then you pause. Anything more than 5% would probably require a reacceleration in inflation, which doesn't seem to be happening. I want to thank you all very much. I appreciate your attention, and thanks for joining the evening.
All right. Good deal. All right. That was fantastic, huh? All right. Thanks again. All right, everyone. We have some, Ann gave me a little to-do list here. So we have some tokens of esteem for you to take home in the hallway on your way out. There's some golf items, industrial strength umbrellas, which you probably don't need this evening, and some little black books. We also would like to recognize the super smart people. They are the ones that get the riddle on a weekly basis, and they are the ones that get to take the centerpieces home this evening. So I will read them off. You have... Yeah. Okay. Well, a little wrestling match or something for the... okay. All right. Cool. Connie Ossio. All right. Linda Bautista. Susie Duncan. The Fabrics. Carrie Pace. Gwen Mauvais. Lori McKay. Jean and Tracy Reddig. And the Tomzaks. All right, guys. Well, thank you very much. I really enjoyed that presentation. Not my part, but Brian's. So thank you very much, everyone, and we'll see you soon.